Hello, everybody. This is Bennett Tchaikovsky, the accounting professor, and I'm here. We're going to learn more about some earnings per share today. Always really, really exciting. So my disclaimer and copyright notice is that the information and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. Presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2026 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Throughout the presentation, I'll make reference to publicly available information that is the copyright of other parties. I do not claim any right to the copyright that I'm referencing in those parties. So here we go. We've got some earnings per share, basic and diluted. And so what we're going to go ahead and do is go through a sample problem, 1.1 of going through and looking at the allocation of bonds and warrants. So let's go ahead and get started in on this. So on November 1st, 2023, Atlas Corporation sold at 106 plus accrued interest, 3,000 of its 8% 10-year, $1,000 face value non-convertible bonds with detachable stock warrants. Each bond carried 3 detachable warrants. Each warrant was for 1 share of common stock at a specified option price of $20 per share. Shortly after issuance, the warrants were quoted on the market at $4 each. No fair value can be determined for the Atlas Corporation bonds. Interest is payable on February 1st and August 1st. Assume the bonds were dated August 1st. Assume any discount and premium is amortized on a straight line basis. Part A, prepare the journal entry to record the issuance of the bonds with the detachable stock warrants. And then we're also going to go through and prepare the journal entry to record the first interest payment. Okay, so as we're going through and doing this, the first thing we want to kind of go through and do is kind of say, well, what are we kind of pegging our value to? And right over here, it says no fair value can be determined for the bond. So what we're going to do first is we're going to basically figure out, well, how do we go through and value the warrants? Now, one of the things I also want to remember too is that when we look at a basic bond, problem when we're issuing a bond, we're going to basically have over here, we're going to be receiving cash. And we're also going to be going through here and crediting bond payable. Whenever we credit bond payable, it is always going to be for the face value of the bond. So let's figure out what the face value of the bond is. So I sold at 106, which is referring to 106% of basically the face value plus accrued interest, 3,000 bonds. Basically, Alice sold at 106, 3,000, it's 8%, 10-year, $1,000 face value. So I sold 3,000 bonds with basically a face value of 1,000. So I'm essentially issuing basically $3 million worth of bonds. Okay, so I know I'm going to have to credit bonds payable for $3 million. At the same time, I'm also going to be debiting cash for 106% of that face value. Okay, so my total cash proceeds here are going to be 3,180,000. Now, the other thing I need to figure out here first, because I know how many detachable warrants they are. I've got 3,000 bonds, and each bond carried 3 detachable warrants. Each warrant was for 1 share of common stock at a specified option price for $20 per share. So these 3,000 bonds, basically they come with 3 warrants per bond for a total here of 9,000. So this is essentially going to be the 9,000 total warrants. And each of these is going to be convertible into 1 share of stock. Now, each warrant was quoted on the market for $4 each. Okay, so what I'm going to go ahead and do is I'm going to essentially say, okay, The value I'm going to assign to the warrants is going to be 36,000. How are we getting that? 3,000 bonds, 3 warrants per bond for 9,000 total warrants. And then we have over here, at $4 per warrant gives us a total of 36,000. So here I'm going to credit additional paid in capital stock warrants over here at 36,000. Okay. Now I'm going to deal with the accrued interest in a little bit. I'm going to do, as you saw in one of my earlier videos, I like to kind of go through and to do that separately. But let's go ahead and kind of figure this out here. So here, my cash proceeds were 3,180,000, and my total credits here, my bond payable, and my additional paid in capital stock warrants are 3,036,000. So here I'm going to have a premium on bonds payable for 144,000. So that's going to be kind of where I'm going to be looking at as far as doing this valuation. So this is going to be record bond issuance. Okay. So now, but I'm not done yet. Also with this bond, right? The bond is issuing, basically the bond earns interest, and the interest rate on the bond is 8%. So the annual interest on the bond is going to be 240,000. But wait, there's more. I'm paying interest semi-annually. So every 6 months, I'm going to be paying it's going to be 120,000. So coming over here now, when I look at this, I also have to basically say, well, they're also paying me accrued interest. So I'm also going to get some more cash, and I'm going to credit interest payable. We'll see why I do this. You can also credit interest expense, but I like doing this as a separate one to record accrued interest from investor. So how much cash am I going to be receiving? Well, the bonds are dated August 1st. Okay. And so my bond was issued on 11/1, August, September, October. So I basically got 3 months. I'm going to multiply this by 3/6, or from August through October. So essentially here, the accrued interest is going to be 60,000 bucks. Okay. Now, what this also asking me to go through and to do is to go through and to say, well, if interest, prepare the journal entry to report the first year interest payment on 2/1/24. Okay, this is pretty messed up. And I just actually am looking at this right now, and I just kind of saw something that we're going to have to do first. And what is it that we're going to have to go through and do? Is I'm going to have to go through and accrue for 2 months of interest expense. And I'm going to, because if I'm recording this, if I have a 12/31 year end, right, I've got to go through. And when I do that journal entry, assuming I have a 12/31 year end, I probably want to add this to the question right here. Basically, let's go ahead and put this here. Okay. So the amount of interest expense I need to go through and accrue for is going to be for 2 months. So how do I go through and do that? Well, if you remember the other bond, the videos we were going through and doing, when we have a bond, premium or a discount, what we ultimately have to go through and do is we have to make that premium or discount go down to zero. So I have this premium on bond payable that currently has a balance of on 11/1/23 of 144,000. Okay, so I know that I need to make this go to zero. So my my journal entry is going to be a debit to interest expense. I'm going to have a debit to premium on bond payable. And I'm also going to have over here a credit to interest payable. Okay, so now when it comes to the interest payable, the interest expense, or excuse me, my interest expense basically every 6 months is 60 grand. Now here, this is going from November 1st to December 31st. So I want to multiply this here by 2/6. I should take that back. Now I screwed that up. Hold on. Okay, so take that back. Okay, so 120,000 is every 6 months of interest. But here I'm going to have to say, well, how much interest did I actually, basically, or how much cash am I going to have to pay out potentially? Well, this is going to basically be 2/6 or from November and then December. So 120,000 times 2/6 is going to be 40 grand. So my interest payable or my obligation basically for those 2 months is going to be 40,000. Now, when I go through and I'm amortizing a discount or a premium on what we call a straight line basis, what does that mean? Well, over here, I have to take 144,000 and basically amortize it down to zero. But because the bond was originally basically dated on 8/1/23, so this would basically, it's going to expire out on 8/31/32. Okay, so we got, hold on, 24, 25, 26, 27, 28, 29, 30, 31, 32, 33. So this is going to expire out on, okay, so this is going to expire out on 7/31/33. Now, if you notice here that basically that the difference between these two, if we look at this in terms of the difference between these two, this is basically going to be 10 years or 120 months. Okay, now, since the bond was actually issued on 11/1, in order for this to go down to zero, I have to amortize it over 117 months. So when I look at the premium amortization, my monthly amortization is going to be 1,231. So since I'm basically recording interest expense for 2 months, this is going to be to accrue it. This is going to be 2462. So my interest expense is going to be 37,538. So to basically accrue year-end interest. Okay, now we're now ready for the big payoff on 2/1/24. What's the big payoff going to be? Well, this interest payable, right, that I went through and have been accruing for, right? So basically this 60,000 and then this 40,000, we're going to go get through and get rid of that. And then I'm going to have basically, as far as my cash is concerned, the amount of cash that I'm going through and paying out is going to be 120,000 because that's my obligation. Every 6 months, I have to go through and pay 120 grand. So now to basically go through and balance this or to figure out my interest expense for the 1 month of 2024, I'm going to go ahead and debit interest expense and I'm going to go ahead and credit premium on bond payable. When I credit premium on bond payable, this is only going to be for 1 month, right? Why is it? It's basically going from January 1st to February 1st. So this is going to be 12/31. And so therefore, my amount of interest expense is going to be 120,000 or about 18,769. And when I add up these two amounts here, this equals to be $20,000, which is really correct because that's really going to be for 1 month of interest when this interest here is being paid semi-annually. So, okay, so we call this to record interest payment. That's a fun one. Okay. So prepare the journal entry, record the issuance of the bonds with the warrants on 11/1/23. Prepare the journal entry, record the first interest payment on February 1st, 2024. Always a good time. Morongo. No, they're not sponsoring me. I wish they were. Morongo, if you want me to make some videos about you guys, Morongo, it's exciting. We'll bring it back. But in any event, that was our first question here. I want to thank you for watching. Please remember to like and subscribe. If you have a comment, please feel free to leave it down below. I'll see you on the next video.